Welcome back. Today we're doing Alibaba. This has been a popular request. They have a $450 billion market cap and are selling for about $167 a share as of market close on Friday. So what does Alibaba do? I think of them as the Amazon of China. There's more details in the description that I got from Yahoo Finance. Alright, so let's look at the share price history. So you can see here I got a 2-year chart. We have had a rough go of it for about the last year or so. Last November you were at $300 a share. Since then it fell all the way to about $140, so 55%, and it's since climbed up a little bit. Like I said, it's sitting at $167 a share right now. Is this going to continue to fall? Will it come back up? I'm not sure, but what we are going to do is look at the valuation and see if it comes in above or below. One thing to note too is that Baba has earnings coming out, I think, on Thursday, so if they are positive and the other fundamentals are positive, that could definitely be a catalyst to see the stock start jumping up again. All right, well, let's get started with the financial statements. First up is the income statement. First thing we're going to look at is total revenue, and this is every quarterly report going back to March 2014. So one thing to keep in mind here is that we're going to be operating in the Chinese currency, and then at the end I'm going to convert to dollars. It was just easier to do that since all the data I got was in yen. So I'm going to keep it in yen, then we'll go to dollars at the end. All right, so look at this growth. This is insane. Usually we like to see revenue growing, and this is growing, but this is almost exponential. It's almost going vertical here recently. Look, just in 2016 they had 50 billion yen per quarter in revenue, and now they're at 200 billion. That's quadruple in 5 years. That's incredible. Love to see that. All right, so let's go to pre-tax income. All right, so pre-tax income is growing as well. Not as fast as the revenue, but that's okay. I mean, look, it's still more than doubled in that 5-year period. So you were at 20 and now you're pushing 60, 80 some quarters. So it's great too. I guess these quarters are kind of offset. These low quarters are kind of offset by the high ones. That's okay. We want to just kind of keep an eye on what the average is doing. So we're using pre-tax income because that's going to be one of our crucial valuation measures. And that valuation is based on a projection of what you think the pre-tax income is going to be. So you don't want to just take the last 4 quarters unless it's been pretty stagnant. This one's obviously growing, so the question is, what do you pick for your pre-tax income? I don't think 80 billion is out the question. I think that's totally reasonable, and I could see that happening if you want to put that. 60 billion is pretty conservative, I think. I'm going to split the difference and go for 70. Look, this is mainly a teaching video so that you learn how to do valuations, but so much of the valuations rely on what numbers you put in. I know I always say it, but investing is half art, half science. The science part is the formulas, the art part is trying to figure out what to put as your inputs. All right, so like I said, we're going to do 70 billion yen per quarter. I'm going to multiply that by 4 to get 280 billion for our yearly projection. All right, next is a growth rate. So what we're going to do here is take our growth in about a 5-year period. So you can see in 2016, we were at 20 billion yen per quarter, and then now we're above 40 billion, but I'm going to use 40 billion. You always want to be a little more conservative with your growth rate because getting an inflated growth rate can really skew your stock price valuation, and you're going to think you found that deal of the century and really you just assume too high of a growth. So what we're going to do is 40 divided by 20. So that's how much we went up in that 5-year period, and you raise that to the 1/5 since it's 5 years, and that's your annualized growth rate. So 14.8%. So I'm going to do 15%. I'm going to round up. Next thing we're going to look at is net income. This one is not a projection. This one is what has the company been doing. So I'm going to take the average of the last 8 quarters. So I just averaged this off screen. You can't see it, but it's 40.4 billion. So 40.4, and I'm gonna multiply that by 4. That is our net income performance that they've been doing. So 160 billion yen. All right, last is earnings per share. Diluted, always use diluting earnings per share. It just saves you the headache of running into a company where they're seriously diluted, but you missed it because you're only looking at normal earnings per share. Usually they're the same, but every once in a while you'll find a company that has a pretty big difference. You just want to stay away from that. All right, so the formula that we're going to use here calls for the trailing 12 months or the last 4 quarters. So we're going to sum the last 4. So we're going to sum this one, this one, this one, and this one. I'm going to do that right here. The sum's off screen, but it's $54. Or not dollars, 54 yen per share. So I'm gonna put that in the outline. All right, as far as the graph looks, again, it's great. I mean, we're triple the earnings per share in that 5-year period. I love to see that. It's growing. This was a great income statement. I hope it continues to the balance sheet. All right, so the first thing we're going to look at is total tangible assets. So this is everything the company owns minus just the intangibles like goodwill or other intangible assets. That's how it's usually categorized on the balance sheets. So what we're going to use this for is to get a return on tangible assets, ROA. I put a little T there to signify that it's on tangible assets. So we take our net income, which is 160 billion, and we divide that by the current total tangible assets, which if you look here is 1.355 trillion. So what we're going to do is turn that into billion, so it's going to be 1355. So 1355, and we get a return on assets of 11.8%. I'm just going to say 12%. That's pretty solid. All right, let's see if that translates to our tangible equity. So what we do is we're going to take this total tangible assets and subtract all of our liabilities, and we get tangible equity. Some people call it tangible book value. It's also called net tangible assets. All the same thing. Basically, it's like a liquidation value of the company. All right, this is incredible. Look at this growth. So I love looking at the tangible book value of a company because in a way it's like its net worth. And I like judging companies on that because that's kind of how I judge my own personal finances, right? You don't look at how much money you're making, you look at your net worth, because I don't care how much money you're making. If your net worth isn't rising, you know what are you doing? So same thing with companies. So we love seeing the tangible book value growing, and look at this. It's going exponential too. Love to see that. Let's see what the return on tangible equity is. So what we're going to do in that case is take our net income again, 160 billion, and divide that by, down here it's 616 because I'm a round up, so 616, and it's 26% return on equity. That's great too. Two very solid metrics for the balance sheet. Great equity, then that's growing. The balance sheet definitely gets a check mark too. All right, so let's look at the cash flow statement. All right, so the only thing we're going to look at in the cash flow statement is free cash flow. Free cash flow, if nothing else, is a great check against your income statement because it's another way to see how much money a company's making. Like I always say, free cash flow, imagine that as just watching the checking account of a company, whereas the income statement is what they're paying taxes on. So you can include a lot of expenses and write-offs in your income statement that aren't really expenses. And likewise, you can be spending a lot of money in CapEx and not really seeing that negative hit on your income statement, even though you're spending a lot of cash. So I love looking at free cash flow and making sure it's somewhat in line with our pre-tax values or net income that we're getting. So we like to see this growing. That's great. This is similar to the pre-tax in that we're going to try to project what we think it's going to be. So if you follow, I know that we have a lot of noise here, but I'm going to just kind of follow these middle lines. And I think, 60 in the next couple of years or the next year or so per quarter is not unreasonable. And I think 40 is too conservative, especially for a company that's growing as much as we've seen. So just like pre-tax, I'm going to kind of split the difference and say 50 billion yen per quarter. So 50 billion times 4, 200 billion yen per quarter. All right, so let's go to our valuations. All right, the first valuation metric is going to be this pre-tax times 10 divided by the number of shares. This is a rule of thumb method. This one, I will say, is not great at valuing companies with a high growth rate, but like I said, it's a great rule of thumb. If somebody tells me about a new stock, it's the first thing I go look at is that it's pre-tax and go multiply by 10 and make sure we're somewhat in line with the current share price. All right, so I'm going to take that pre-tax number of 280 billion yen times 10, and what we're going to do here is divide by the number of shares, 2.7 billion, and we get 1,037, but we have to convert that to dollars, and I have this little conversion here you can see on the valuation side. So 1 yen is equal to $0.16 or 16 cents. So I'm going to multiply this times 0.16, and we get a target share price of $166 per share. Pretty in line with the share price. I'm actually impressed that our pre-tax income got close to the share price because usually on the low side, especially for growth companies. Next is going to be our earnings per share and growth combo calculation. That is a formula from Ben Graham's book, Security Analysis. So what we do is we take our earnings per share, which is 54, and multiply that by 8.5 plus 2 times our growth rate, which is 15%, so times 15. And we have to convert this to dollars as well, so times 0.16, and we get $333 per share as our target. That's awesome. Good to see. So last, we're going to do the discounted cash flow method. So what we do here is we're going to take our free cash flow in billion dollars, so I have to convert that to start off. So 200 billion times 0.16, so that's 32 billion. I put that here. And then our perpetual growth rate, which you always want to pick something lower than the growth rate that you used. I'm going to use 9%. It's kind of arbitrary, but as long as it's lower, it's okay. And then your discount rate. My discount rate is always 15%. You can go higher or lower. I don't recommend going higher. I think that's a little too harsh, but a lot of people discount at 7 or 8%. All right, so then our net present value for our market cap after 100 years is $610 billion. So I'm going to divide that by the number of shares, 2.7, and we get a target price of $226. All right, so we have 3 valuation metrics. Our pre-tax came in close to the market value, and the other 2 came in way above. I mean, one of them's suggesting close to 100% upside. I think on average, let's see, if I average these 3, I get $242 per share. That's like a 40-50% upside on the current price. Well, let's see, 242 divided by 167. Yeah, that would be a 45% increase. So I think the stock is definitely at a major discount. We saw 0 red flags. We saw nothing but growth, growing revenue, growing income, growing equity, growing cash flow, and yet the share price is, very depressed. So does that mean it's a great time to buy? Well, there's a lot of fear around this stock and in general Chinese stocks because of potential interference by the Chinese government. One of my favorite investors, Charlie Munger, he had a huge position in Alibaba before the dip, and whenever his recent filing came out after the dip, it showed that he has an even bigger position now. So he used the downtrend as an opportunity to buy more because he's that confident, and he's the source of our quote up top today, and I think it definitely applies to this stock. He thinks everybody's wrong about the Alibaba fear, and he has a pretty good track record. It's very rare that you see a company that's this good at this much of a discount, but it definitely does have that big cloud hanging over it. But don't take my word for it. I'm not a financial advisor. I encourage you to do your own research. If you enjoyed the video, if you learned something, please like and subscribe, and I will see you next time.